Hello everybody. Today let's take up the topic of depreciation. So first of all, let's see what is depreciation. Here I have written the meaning of depreciation. Depreciation means a fall in the value of an asset because of usage of the asset, or due to lapse of time, or due to obsolescence of the asset, or an accident. Depreciation is basically given for all the fixed assets. So here I have written every fixed asset loses its value once it is put to use or otherwise. Even if the fixed asset is not used, it is being kept like that. If you purchase a machinery and you are not using that machinery, it's being kept aside, still it loses its value. So still the depreciation occurs in the fixed asset, and if it is being used, then obviously it depreciates. So every year we provide a certain percentage as depreciation, and the value of the asset comes down, right? So depreciation is a fall in the value of an asset. Okay, now let's see, why should we provide depreciation? So what is the need for providing depreciation? First of all, this depreciation is a cost, right? So whenever we are using the fixed assets, right, whenever we are using the fixed assets are being used for producing some goods, right? So here I have written, when goods are produced, it involves the use of fixed assets. So a decrease in the value of the fixed assets should be treated as a cost of production of the goods, right? So if the fixed assets are being used, obviously there is a decrease in the value of the fixed asset. Some part of the fixed asset is being used, right? So that should be treated as a cost, fine, and it should be shown as an expense in the profit and loss account, though we are not paying anything for that, but it should be shown as a expense in the profit and loss account. It should be put on the debit side. Only then the profit or loss will come correctly. If depreciation is not shown, then the profit or loss will not be correctly ascertained, right? The next thing is to show a true and fair value of the financial position. So whatever assets you have, that is being shown in the balance sheet. So we should show a proper value of all the assets that we have, right? And to show the assets at its proper value, so whatever depreciation we are providing, we have to deduct that depreciation from the value of the asset, and then the proper value of the asset is shown. Suppose I buy a machinery for 1 lakh rupees, and after 5 years I still show it as 1 lakh, it doesn't show the proper value of the asset. Every year, let's say if I am providing 10% depreciation, so every year the proper value of the asset should be shown, that is after deducting the depreciation it should be shown in the balance sheet, right? So this is the need for providing depreciation. Now let's look at the different methods of providing depreciation, with which we will be starting the practical questions. The first method that we will be learning here is called the straight line method. Now straight line method, we also call it as the original cost method. Under this straight line method, a fixed percentage is given for depreciation, and every year that percentage is taken out on the original cost of the asset, right? Okay, so here let's say if the original cost of the asset is, let's say, 1 lakh, and let's say like this, depreciation is to be provided at 10% per annum on straight line method, Now suppose I want to show the depreciation for 3 years. Now here let's say the asset is purchased on, let's say, 1st January 2014, right? The financial year is January to December, let's take. For 3 years, for the year 2014, it will be 1 lakh into 10%, right? So 1 lakh into 10 by 100. 2015, again it will be the same. It is on the original cost. So every year the same amount will be coming, right? Because you are taking it at the original cost. This is the depreciation you will be providing every year. Okay. So this is the straight line method. So in the straight line method, a percentage of fixed percentage of original cost of the asset is written off every year, right? And it means that the amount of depreciation will be the same every year, right? So here I have shown you an example. This is how it is to be done. For every year it is going to be the same amount. Fine. Okay. Now supposing we are given the number of years of expected life. This is for the asset. Suppose let's say it's 10 years for an assets. Fine. Okay. And the estimated scrap value is given. So after the end of 10 years, what is the estimated scrap value for the asset? That's given, let's say, and the original cost is also given, right? Original cost of the asset is also given to you. Now if all these things are given, we can calculate this depreciation with this formula, which is cost minus estimated scrap value upon number of years of expected life of the asset. Right? Now the straight line method is a very simple method of calculating depreciation, and once you calculate the depreciation for 1 year, it is going to be the same for every year, right? Okay. So this is the first method that I am going to take up with you. I'll take a small question now on this method. Let's say ABC Limited purchased a machine on 1st January 2000, let's say 13 or let's say 12, right, at a cost of 1,40,000 and spent rupees 10,000 on its installation. The company decides to write off depreciation at 10% per annum every year on the original cost of the asset. The books are closed on 31st December every year. Show the machinery account and depreciation account for it's 12, 13, 14. Let's say for 2 years, right? Okay, now let's do this machinery account. First of all, the machinery account. Whenever an asset is purchased, if there is any installation cost of that asset, that is to be capitalized, that is to be taken as a cost of the asset, right? So in this case, this 10,000 which is spent on the installation will be added to the cost of the asset. So when you provide the depreciation will be on 1,50,000 and not on 1,40,000. Now here let's see, first of all, the date you will write 1st January 2012 to bank account. This is the purchase of the asset, 1,40,000, and again on the same date you have another 2 bank account. This is for the installation basically, right? I'll put it like this, installation, and this is 10,000 rupees, right? Now depreciation is always provided at the end of the year, right? So here on 31st December 2012 we'll write by depreciation. Fine. Now that depreciation will be, this is, I'll take the cost of the asset as 1,50,000 here because this installation will be added to that, right? So now that will be 1,50,000 into 10 upon 100 for the whole year. The asset is purchased on 1st January 2012, right? So 1st January to 31st December, it's the whole year, so we have to give it for 1 year, right? So here it will be 15,000, fine. So by depreciation we'll have 15,000, fine, and then this is, you have to balance this now. Here this is 1,50,000 and here it is 1,50,000, and on the same date, that is 31st December, you will have by balance carried down 1,50,000 minus 15,000, right? So that will be 1,35,000, fine. Now this is the balance which will be brought forward to the next year. Let's here 2013. So here we will have 2 balance brought down, fine. So this is 1,35,000. Now again for this year the depreciation is provided at the end, 2013 December 31st. By depreciation the amount is going to be the same for the whole year, right? Okay, so here again it is going to be 15,000, and on this date you will do a balance carried down. So 1,35,000 minus 15, you have to balance this. So here this is 1,35,000, 1,35,000, right? $1,35,000. So here the balance is 1,20,000. So I am showing it only for 2 years in this case. So you will have to show the machinery account as the as per the question. If the question says for 2 years, 3 years, whatever, accordingly we have to show, right? 2 balance brought down, and here you will have 1,20,000. This is the machinery account that has to be prepared, right? So in the machinery account, remember that this depreciation will always come on the credit side, right, and whatever assets you purchase, that is going to come on the debit side, right. Now let's see this depreciation account, how to prepare this depreciation account. Depreciation account, here you see it's very simple. In depreciation account, you just have to show the amount of depreciation that is provided every year, and at the end of the year you have to transfer it to the profit and loss account. See, so in the debit side you will write 31st December 2012 to machinery account. The amount of depreciation provided this year was 15,000, right, and at the end of this on the same date, right, this is also at the end of the year, here you will write to profit and loss account, right. This amount is transferred to the profit and loss account every year. It's shown in the profit and loss account. Fine. So that's it. So there is no balance here, right. Whatever is the amount of depreciation, that is directly transferred to the, sorry, this is 2013, 31st December 2013. Again you will have to machinery account, and again the amount of depreciation, in our case it was the same, so 31st December 2013. Here it will be again to profit and loss account, 15,000, right. So this is the depreciation account for 2 years. So this is a very simple question which I have taken up today. In the next session I will be taking up another question on the straight line method. I'll be showing you some more examples of the straight line method. So with this I come to the end of this session. Bye.